This Canadian retailer is on the top of the list of my list of stocks that I'm going to be doing a review for, so today I finally got around to it. And this retailer is actually my favorite Canadian retailer on the TSX right now that I own. And if you guys haven't guessed it, it's Aritzia. Nope, not Canada Goose, but Aritzia today. So the breakdown for this video will be the following. First, I'll be going over the stock charts. Then I'll be talking a bit about the business and what they've done over the past year, followed by the financials and the most recent earnings report. And lastly, I'll be giving my opinion as well as letting you guys know how much Aritzia stock I currently own in my WEALTHSIMPLE portfolio. If you guys are trying to find the ticker symbol for Aritzia, it's ATZ and it's traded on the TSX. So when we look at the charts, we can see that Aritzia IPO'd somewhere in 2016. And when it IPO'd, the stock price sold off fairly quickly in the next year or so. And then it finally recovered somewhere in the late 2017, and it continued moving up to its all-time highs of $26 in February this year. February was basically the top of the entire stock market, and in March, when COVID hit North America, Aritzia, like all other stocks, sold off rapidly. And the stock dropped as far as $9.36. And since then, though, it has recovered to about $20 today. There's a support level currently if we look at the charts, and it's sitting at around $19.50, which you can see on the screen right now. And recently, in the past month or so, it's broken through the support level twice. Currently though, the stock is trading above its 50-day, 100-day, and 200-day moving average. It is still 23% off from its all-time highs back in February. Now moving on to what Aritzia does as a business. So Aritzia is a vertically integrated, innovative design house. They offer exclusive fashion brands for everyday luxury, which they've actually coined that term. And each brand has a distinct aesthetic towards it, such that it caters towards people in different life stages as well as lifestyles. Although they have multiple in-house brands that look different, there are three core pillars that will tie all these brands together. The first one being they use superb fabric. The second one is that they're meticulous about their construction or manufacturing of these clothes. And lastly, they design all these clothes to be relevant for whoever they're targeting. The company was founded in 1984 by Brian Hill, who currently is still the CEO, and Brian Hill is actually a third-generation retailer, which means that he's got retail in his blood. So Brian Hill, being raised by parents and grandparents who all went through the whole retail business, he has a lot of experience based off of what he learned growing up as a kid. If you guys have ever come across an Aritzia store, you'll know they have a very iconic, chic look. Basically, it's like when you look at the front of the store, it looks like you could be walking into a boutique. And when you actually enter the store, there's different sections along the sides, which are basically sectioned off, and I believe they have different brands within each of these sections. So when you walk into those sections, it feels like you're walking into a smaller boutique where the clothes there are all matching and they cater to a certain lifestyle and a certain life stage of person. But if you look around the store, somehow all these brands work together and the different styles work together to make one nicely designed store. Aritzia really pays attention to the aesthetics of their store, including the different accent pieces they have like chairs, as well as the mannequins that they use. It's actually quite different from stores like American Eagle or Gap, where they just use those like plain white mannequins. Aritzia actually uses mannequins that are kind of hung from some sort of like copper piping, and they have a very sort of like British tailor style mannequin on there. Now a couple highlights about Aritzia's business. So if we look at the past 20 years, the compounded annual growth rate of Aritzia's net revenue has been 17% year over year, and they've never had a year where their net revenue dropped compared to the previous year. Aritzia is currently expanding throughout the US. If you take a look at the map, you can see that Canada, for the most part, there's stores in every single province, not in the territories because it's a very small population there. However, all the major provinces and even some of the smaller provinces have stores. But if we look at the United States, only about 10 states have stores in them. And that roughly equals to 20% of the states who have Aritzia stores. So Aritzia still has a lot of room to expand in the US. Management is very careful when selecting their store locations, and that's probably why Aritzia hasn't expanded that quickly compared to other retailers like Gap or Old Navy or American Eagle. But the one thing you should note about management is that throughout the 35 years of operation, Aritzia has never closed a store permanently. They had their temporary shutdowns because of COVID. They've never actually shut down a store because that store was performing poorly. Taking a look at store growth, we can see that in year 2017 they had 79 stores. Then moving on to 2018, they had 85 stores. And then when we moved to 2019, they increased it to 91 stores. And for year 2020, they increased that to 96 stores. And just to note, their 2020 fiscal year actually ended on February 28th of 2020. So as of today, they reported the first quarter of 2021, which we'll be talking about a little bit later on in the video. And we all know right now that Aritzia had to close some of their stores. Actually, most of them were closed in March. But as of July 9th, Aritzia has reported that they've opened up 89 of their 97 stores. But the one thing you guys should know about Aritzia opening up stores, they've actually implemented some measures in order to address the whole public safety concerns. These things are like sanitizing their changing rooms after every single usage, as well as employing one health and safety person per store. So that is going to increase their expenses by about $4 million per month. And on top of all this, retail stores will not get back to the 2019 levels yet because of the maximum capacity they can have, which is about 30% occupancy, as well as just general consumer fear and less people going out to shop. So these are all the things that are going to impact their in-store sales. For my female audience out there who's watching this video right now, and if you guys shop at Aritzia, you guys will have noticed Aritzia has done more sales in the past couple of months. And they launched 2 different major online sales. And that's because they were trying to move inventory because they had a lot of inventory in stores, and that inventory sitting in stores is no good to Aritzia. They needed to sell it, so they launched a bunch of sales. So lucky for you guys, if you guys love Aritzia, you probably got rewarded with some nice sales. And in the latest earnings call, management decided not to give any sort of fiscal guidance. However, they did give some idea to investors what they're going to be doing in their business in the next year. So their plans are to open up 5 to 6 stores in the next year, as well as they've identified another 100 locations in the US where they can open up more stores. So you can see that Aritzia has possibly a lot of growth ahead of it. And they're going to continue marketing using social media, which has worked very well for them. They've actually had influencers like Meghan Markle wear their clothing. This has brought in a lot of press and brand awareness to Aritzia right now. And that's how they've been able to grow in the past 5 to 6 years with social media marketing rising. Now jumping over to the latest quarterly earnings and giving a few highlights from that. So Aritzia actually reported that they had an e-commerce revenue growth of 150% year over year. And this is actually very phenomenal because basically they've 2.5 times their previous year's e-commerce sales. However, one thing to note, e-commerce was not their major channel of sales, it was their in-store sales. But nonetheless, this is a good thing for the e-commerce side because when people shop on the e-commerce site, they have to give their email, and now Aritzia has another way to market to their customers. And they noted in their earnings call as well as on their investor presentation that the US e-commerce sales have been the fastest growing revenue segment in the entire business. And this is good news for Aritzia because, Canada e-commerce sales is very small compared to US e-commerce sales. The Canadian population is about 1/10 of America. So if they can continue to scale up their US e-commerce sales, this is going to be really good news for us investors. Although their e-commerce revenues increased by a dramatic amount, their net revenue fell by also a dramatic amount. It fell by about 43% year over year. And that's almost half. As an investor, should you be worried about this? I don't think it's as bad as other retailers where they probably lost 50 to 60% because there's a lot of retailers who aren't prepared for this and they didn't have the e-commerce set up. But Aritzia having e-commerce, it helps soften the blow. And with a 43% decline in revenue, analysts actually predicted worse for the business. So this is why you probably saw the stock rally after they released their quarterly reports. And a few other things to note is that they drew $100 million from the revolving line of credit. And this is going to help with their liquidity going forward in the next year or so. As well as they don't have any major loans to pay back until next year, where there's a $75 million loan that they owe. If we take a look at their balance sheet to see the health of this company, we can see that the current assets and current liabilities are roughly equal, and they have a current ratio of 1.1. So typically when looking at companies, especially in this pandemic right now, it's good to look for companies with a current ratio of 2 or more. With a current ratio of 2 or more, it gives them a lot more liquidity in case some unforeseen costs come along. But Aritzia with a current ratio of 1.1 means that their current assets are able to cover all their current liabilities and a little bit more than that. So if worse comes to worse, they can cover their current debts. If we take a look at their total ratio, which is their total assets divided by their total liabilities, it's roughly equal to 1. Maybe a little bit higher at like 1.2. However, if we dig a bit deeper into their assets and their liabilities, we can see in their assets they have about $150 million of goodwill. If you guys don't know what goodwill is basically the extra amount of money that they paid to acquire a business. So if the business was worth $200 million and Aritzia paid $300 million, $100 million of that has to go in their goodwill. So basically it means they overpaid for a business that they acquired. And on top of that, they have something called the right of use asset. And what this asset is basically offsetting their lease liability. So they have the right to use the stores that they have a lease for the next 5 or 10 years, whatever the term is. And this essentially counteracts the lease liability they have. So when looking at the total assets and total liabilities, I would suggest removing these 3 items, and you'll get a total ratio of roughly around 1. And as an investor, what this means to you is that if the company goes bankrupt and has to sell everything and pay back all their debts, it means that you get nothing, because all the assets, when they sell them off, are just enough to cover all the liabilities. Now turning over to the income statement. For Aritzia, they had a gross margin of around 10%, which is fairly low for this business as their historical averages are around the high 30s or low 40s. But with COVID-19 hitting, this has greatly impacted their margins. And this is because they still have to continue paying some rent or paying some utilities as they can't completely abandon their leases. And with these fixed expenses fixed and their revenues decreasing, their gross margin is ultimately going to get hurt. And as I mentioned before, they had a 43% decline in the net revenue. In this quarter, they had a net revenue of around $111 million compared to around $196 million in the year before. And I don't think this is something to worry about too much because it's more of a short-term thing. Once COVID goes away and society returns back to whatever the new normal is, they're going to see their sales continue to increase. And if we look at the trailing 12-month PE ratio with this quarter's results added into that, they have a PE ratio of around 41, which is very high compared to its historic averages of somewhere around 16 to 22. However, I think investors didn't sell off the stock rapidly because they realized that COVID-19 is only a temporary thing. And Aritzia stores were fully shut down for the month of March and April. But as of July 9th, as I mentioned before, they've opened up roughly around 90 to 95% of their stores. So this should help the revenue in the next quarter. And management actually reported in the quarterly earnings call that in the first 5 weeks of the second quarter, they saw their net revenues only decline around 25 to 30% compared to the year before. So it's already getting better. Instead of a 43% decline, it's only a 25 to 30% decline now. And if we take a look at Aritzia's cash flow statement, we can see that they actually generated a positive net cash flow from operating activities. And although they had a negative earnings per share, the reason why they had a positive cash flow is because their depreciation and amortization expenses were quite high, as well as they reported a positive net change in non-cash working capital balances. And both these things, when taken away from the EPS, show that they generated a positive cash flow from operating activities. And on top of all this, they actually pulled out $100 million from the revolving line of credit, which further increased their cash flow. And ultimately, they saw an increase in cash flow for this quarter of $106 million. And one last thing to note when looking at their financial statements is that their share count has actually been decreasing over the past 2 years. It actually decreased by 7% since 2017. And this is a great thing for investors because that means there's less pieces of the pie to give out to other investors now. So each share that you buy is worth a little bit more of the business. And if you guys have looked at previous quarterly results, you can see that management has actually been buying back shares at levels around $13, $15, and $17. And these are all lower than the current share price today. Now jumping over to my opinion on Aritzia stock. Before we get there though, I'm going to disclose that I do have a position in Aritzia. And for those of you who have been watching my channel, you'll know in the Investment With Me series that I own Aritzia. So currently today, I own around 75 shares of Aritzia in my WealthSimple portfolio, and I have an average price of $16.16. I'm up over 23% or $230 on my position. So some of the risks I see going forward here if you were to open up a position in Aritzia are that number one is that the new consumer norm is very unknown right now. As people return to normal or whatever the new normal is, we don't know how consumers will behave because are masks going to be mandatory in malls forever? Will we be needing more hand sanitizer? Will there be social distancing? These are all things that could actually deter people from doing in-store shopping. And right now, in-store sales for Aritzia is the main way that they generate revenue. And on top of this, Aritzia also uses their stores as marketing tools as well. So if less people go to stores and they get less foot traffic in the stores, the investment into stores is not going to be as fruitful as before. Another risk for Aritzia is that retail is very unpredictable. And we can see this with the rise and fall of different retail giants, especially in the fashion industry. So first off, if we take a look at Abercrombie, this brand was super popular in the early 2000s, as well as Gap, which is popular I think in the 1990s and early 2000s as well. And J. Crew was also a big brand before. However, J. Crew has actually recently filed for bankruptcy. So you can see that fashion trends change all the time, and as long as Aritzia keeps up with the fashion trends, they can continue growing their business. However, if they go out of style like these other three brands that I mentioned, they're going to have a lot of pain ahead of them and need a lot of readjusting. Otherwise, they go bankrupt. Aritzia's balance sheet is nothing to be marveled at. With a current ratio of 1.1, this still presents a lot of risk going forward. Because if there's any unforeseen costs, and possibly maybe a second wave of coronavirus coming, this current ratio might not be enough to weather the company through the storm. And lastly, sales are still down fairly significantly, and we don't know when they're going to be returning. They did draw from the revolving credit facility, which will help them cover their current liabilities. However, if sales don't return to the levels of 2019 or even 2018, Aritzia is going to need to find a way to raise more cash. So this could be either more shareholder dilution or finding a way to draw more loans. So turning over to the pros of this business, there are three things that I really like and a few more that I'll mention. So the main three things that I really love about this business is that they have a founder-led business, so meaning that Brian Hill has been the CEO since the start and he's continued to carry out his vision and he's shown that he's able to execute. The second thing is that Aritzia has a very unique boutique feel to their stores, and this differentiates Aritzia as a business from all their other competitors. This has been resonating with their customers because looking online, you can see that there's a lot of positive reviews about Aritzia and people even claiming to have 50% to 100% of their wardrobe being Aritzia alone. And lastly, their track record of never having to permanently close down their stores is very impressive in my view. It shows to the intelligence of management of them being able to draft up a plan and execute it according to plan. And the fact that they were able to drive up their e-commerce sales by 150% also shows to me that they have a lot of brand loyalty from their customers. Because although they're not able to shop in stores, they still go to Aritzia's website and want to buy clothing from there. Going forward for Aritzia, they have a lot of growth ahead of them, which I mentioned before. They have 100 possible locations where they could continue opening up stores, and all these locations are actually located in metropolitan areas. And Aritzia does this because they're very picky about where they want to put their stores, and they want to gain as much foot traffic and eyeballs as possible. Their stores are not only used for sales, they're also used for marketing. As people walk by Aritzia's stores, their eyes will gravitate towards Aritzia because of how distinct it is compared to the rest of the stores. And I think Aritzia's brand image is actually ingrained in a lot of retail shoppers' minds. And the messaging that the storefront gives, as well as the entire aesthetics of the store, they have a very chic brand, it's very minimalistic and also relevant. And this is the trend right now with women's fashion as well as men's fashion. And despite all this turmoil that's happening in the world right now, Aritzia's management has indicated that they're still continuing to expand, while other retailers are actually shutting their doors, like J. Crew, I think JCPenney's in trouble, as well as Macy's. So as other retailers are shutting down and Aritzia is expanding, they're able to capture a larger market share of the retail space. And with the expansion of the company and sales volumes increasing in the future, this is going to also drive down the cost of goods sold. So Aritzia is going to have a lot more bargaining power with their suppliers as well as their manufacturers as they increase their volume. So this ultimately will impact their gross margins, and maybe we'll see gross margins of somewhere around high 40% to low 50%. And this is very impressive for any sort of retailer. One of the highest margins in retail that I know of right now in the Canadian market is Canada Goose, and their margin is roughly around 65 to 75%. And I'm sure if you look at even higher end luxury brands like Louis Vuitton, their margins are probably in the 90 to 95%. Because their prices are high and their volumes are low, they need to have huge markups in order to sustain their business. And the last optimistic sign for Aritzia is that their sales decline for the second quarter is not as bad as the first quarter, at roughly 25 to 30% compared to 43%. So we can see that Aritzia's business is starting to recover in this next quarter, and we'll probably see an even faster recovery going forward into Q3 and Q4 as well. The fact that Aritzia's share price has not really increased since its IPO, yet their net income has continued to increase year over year, I think that right now, if you're a long-term investor and really want to get into the stock right now, it might not be a bad idea to open up a small position in Aritzia. And if you're going to do that, I would definitely recommend using Wealthsimple Trade because you're able to buy as little as one single share of Aritzia and pay 0 commission fees. So if you're interested in signing up for Wealthsimple Trade, use the link down below and you'll get $10 for free once you trade $100 worth of stock. And currently with 75 shares, Aritzia is around 10% of my portfolio in Wealthsimple, and I don't plan to continue averaging in at these prices because I got it for $16.16. And I think I'm comfortable with this 10% allocation to Aritzia of my portfolio, and if it does drop below $19.50, I may consider adding more. If you enjoyed this analysis on Aritzia, be sure to smash that thumbs up button, as well as leave any comments down below if you have any questions on Aritzia stock. And hit that subscribe and notification bell for more stock analysis on Canadian companies. Keep up the grind and have a great day.